Hello and welcome to today's Your Daily Five. I'm Tom Bowley, Chief Market Strategist of EarningsBeats.com. And given the pandemic, I want to share with you 5 charts or themes that I believe will serve you well in the coming days and weeks. I want to start off with the S&P 500, and I want to take 2 looks at the S&P 500. First, I want to go through and just show you the long-term 100-year picture so you can really get a feel for the big picture. And then we'll move into a shorter, maybe 5-year weekly chart to get a better sense of what's taking place here just recently. The S&P 500, though, if you look back over the last 100 years, you go through periods, and I'll define those as secular bear markets, which are in the red shaded areas, where you can see long-term periods, 10, 15 years, where the market goes nowhere, just sideways action. And then we go through what are called secular bull market periods. You can see the 50s and 60s, the 80s and 90s, and now what I believe is another secular bull market. So the long-term picture to me, before we even take a look at what's going on in the S&P right now and throughout this pandemic, I believe we're in a secular bull market. And I think ultimately what we're going through in 2020 is going to look a lot like what we saw back in 1987, where we had the crash and then we simply came back from it and went on to set new highs within the next year or two. That's what I'm thinking. Now, if you look at the S&P 500 on a weekly chart, you can see the damage that was done technically in February and March. We've rebounded. We've gotten all the way back up to this 20-week moving average. But you can see last week we failed. We got up through the 2,900 level, got through the 20-week moving average, and then came back down and closed near the lows. I think that sets the market up for more sideways consolidation, maybe even a little bit of selling here as we move into latter parts of May or throughout May. I wouldn't be surprised to see us maybe do a little bit more consolidation. The next theme I wanted to talk about is the volatility index. So we've been through this period. We've been extremely fearful. And what I have here on this chart is a 5-day moving average of the volatility index. So you can get this by simply going down and typing in or using the invisible chart and then having a 5-day simple moving average as an overlay. That's how I get just the 5-day moving average to show up. But when you see the 5-day moving average going through periods like this where we're rising, check out what happens with the S&P 500. Every time when we get that VIX moving to the upside, we see the S&P 500 sell off. So what we have is inverse correlation. So whenever the VIX is going up, we can expect that the S&P 500 for the most part is going to go down. One other thing I'll point out from this chart, from the correlation, is when you start to see the VIX and the S&P 500 moving together in the same direction, and that happens when we get up near this zero line or maybe even start to move into positive territory, it's telling us that the S&P 500 is moving higher, but fear is beginning to build. And if you notice, some of these periods occurred right before these drops. So you can take a look at some of these spikes in this correlation moving into positive territory or getting close to moving into positive territory. And when that occurs, you can see that some of these declines, rather lengthy declines, have occurred. So there's a couple of things that you can take away from this chart. Number one, when volatility is on the rise, you want to be very careful with your stock positions. It's certainly time to become more cautious, maybe think about hedging and so forth. And then also note when you're starting to see a little bit of positive correlation, because if the S&P 500 is moving up, but we're starting to get more fearful, that would also indicate that we may want to take a little bit more cautious approach to the market. The next area that I wanted to talk about, the third theme, is gold. And gold's been doing really well. 2018, 2019, 2020. You can see gold has actually been rising. We were down below $1,200 an ounce in 2018. Now we're up, getting closer to 1,800 right now, or last week we closed, yesterday or Friday we closed at 1,700. So we've had a nice rally, but I just want to caution you about being too aggressive in gold. Couple things to remember with gold. I just talked about volatility. One thing that really helps in terms of performance of gold is when the market is extremely volatile. So when that VIX is picking up, which I just showed you, that volatility, when we're seeing the volatility, that 5-day moving average on the rise, gold tends to outperform the S&P. This part of the chart right here is a relative strength chart, gold versus the S&P 500. If you notice, for the past 40 years, for the most part, this goes down because when the stock market is rising, gold tends to underperform. Gold is much better as a hedge when the stock market is struggling and fear is building. So that's one thing to keep in mind. When you see the VIX moving up, that's the time you might want to think about getting a little bit more bullish on gold. And so we have seen a little uptick here in 2020 in terms of relative strength. I do not believe it's going to last, though. The other thing that you've got to watch is the dollar. When the dollar is on the rise, that normally keeps the price of gold down, at least on a relative basis. So when the dollar is rising, the typical reaction is for gold to underperform the S&P 500. So really, I'd watch two things with gold. Number one, volatility. When the market gets very fearful, we want to make sure that we've got maybe a hedge in place with gold. And also, when the dollar starts to decline, like it did back in the first 10 years of this century, 2000 to 2010, 2011, you can see that was a good time for gold relative to the S&P because the dollar was weak. My fourth theme, and this is really more specific to what we're going through right now with the pandemic. I believe there's a new normal in place. When we first took our hit back in February, this is a chart of the QQQ, which tracks the NASDAQ 100. If you look at the QQQ, we took this first hit, and you can see the accumulation distribution went down as well. If you're not familiar with accumulation distribution, it really focuses on what happens during the trading day. It ignores gap ups and gap downs. It's not looking at where we closed yesterday, how we're trading today versus where we were yesterday. It's looking at where we finished today versus where we traded today. So it's looking at the close relative to the high and the low. That first move down in February, you can see the AD line really struggled. Since then, however, you can see that we continued moving lower, but the AD line continued pushing higher. And so what we've ended up seeing is a lot of areas have outperformed and shown accumulation during this period, while other areas have been very weak. And I just want to go through some charts very quickly to show you what I'm talking about. Healthcare. From this moment at the end of February, we kept going lower in healthcare, but the accumulation distribution kept going higher. Then we had biotechs, prices going lower, accumulation distribution going higher. Toys, prices going down, accumulation distribution going higher. But if you look at some other areas that were weak, look at the airlines. Airlines continued moving down, but we didn't get that pop in the AD. Instead, the AD line keeps moving down. This is a sign of distribution, in my opinion. Same goes with recreational services. Moving down, and then, throughout this February, March, April period, kept moving down with price action. We haven't seen that relative strength. My final chart today, I just want to show you a chart of the portfolio that I keep. It's my model portfolio over at earningsbeats.com. This model portfolio since inception now is up 50%, while the S&P 500 has been up 5%. This was through Friday. You can see the huge move back to the upside since mid-March, whereas the S&P's just bounced back a bit. I just wanted to point this out because these stocks in the model portfolio are selected every 90 days, and the next time we're going to be picking the stocks that go into this model portfolio will be May 19th in just a couple of weeks. So I would certainly invite you to come over and join me at earningsbeats.com and be prepared for the next round of portfolio stocks that we'll announce here in just a couple of weeks. Want to thank you for tuning in. This Your Daily 5, great feature here at StockCharts. I'm glad to be a part of it. Everybody have a great day. Happy trading.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.